We are live. All right, good enough. Let's stop that little share and say hello. Greetings, everyone. I am very glad you're here. And we are going to talk macro to micro in this next macro to micro power hour. I am Samantha LaDuc, founder of LaDucTrading.com, and I am joined by macro advisor Craig Shapiro. That's his handle in our client workspace in Slack, where he posts his analysis on the macro backdrop and then how to trade it, helping also clients position. I am excited because there's a lot of action to trade, but there's also a lot of macro currents that are running at cross currents, and right now consensus is confusion. So we're going to hop in this time frame and kind of try and dissect and unpack some of the big inflection points that may be upon us right now. And I'm going to turn it over to Craig and give me your thoughts, Craig. What's your take of this market backdrop, especially since the narrative has switched dramatically from pivot pause to a growth engine that will have no end, no soft landing, no hard landing, just no landing. That's basically the market mantra right now. What's your take?
Yeah. So I think we hit the data trifecta for January with the data that we've seen, to start February. So we started with the payroll data, which was a blockbuster, and then we got the CPI data yesterday, which had been guided to be stronger than last month and stronger than expected, but was still a very hot number. And then finally today, retail sales, and I think what the market has done is the market's fear, and maybe even the Fed's fear about a slowdown and about an imminent recession exiting 2022 and at the start of the year, that case is, for now has been largely thrown out the window. I mean, we'll see ultimately what happens. I suspect a lot of the strength in January had to do with weather. It's unseasonably warm weather. Helped in a lot of ways, and that showed up today, the IP data, where you saw utilities production down 10% year on year. So that clearly helped. So I don't want to get too far ahead of ourselves on the strength of the economy, but clearly, given what was priced by the bond market and in the rates markets and FX markets to start the year, was an imminent slowdown and a Fed cutting cycle, and that's been largely pushed out. And so Fed terminal rate kind of into the payroll print was in the 480 to 485 range, which was below the Fed's dot for this year of 510. So since that low at the beginning of February, terminal rate today has moved up very close to 50 basis points. I mean, I think we ended today, about 5.26. I think we got as high as 5.3% this morning. So the bond market has moved very quickly. Rate cuts, which were, we were looking at kind of, north of 2 cuts for 2023. Those have largely been priced out. Less than 1 cut now for this year. An aggressive rate cutting cycle for next year. We can talk about that later. But and what we've seen is the dollar start to find a floor and starting to move higher as the market has priced out these rate cuts. So broadly, that's also meant, though, surprisingly, an equity market that's been resilient. And then we'll talk a lot about that, today, but that's definitely something that I wouldn't necessarily have thought. I think it has a lot to do with the zero data expiry options shenanigans, which is taking over, become, a life of its own, and becoming north of, 50 or 60% of daily option activity. And I suspect Friday is going to be, we talked about this last webinar, but Friday is the monthly OPEX for February. That means every security that trades is a zero data expiry option on Friday. So it could just be, again, kind of crazy activity. That's been helping keep overall U.S. equities better than I would have thought. But there's definitely, under the hood, some things that are concerning as the dollar rallies and liquidity is withdrawn. The China stuff's been selling off, some of the cyclical stuff starting to fade. So that's where I've been focusing some of my attention. But and that's kind of where things stand right now.
Okay, so basically months and months of hearing that recession didn't matter, we were going to have a soft landing. Don't worry, the market, is basically leading the Fed and pricing in rate cuts. Those are gone, right? So there's practically the big flip, although it's referring to kind of the growth engine. I have had this thesis, as you know, since mid-October, more in the line of central bank intervention and very much Bank of Japan. And I'm showing that dollar chart because I think it's just critical to understanding how the wind is blowing. But we had this fabulous advance. This is Dixie basically on a weekly, and this is on a daily. And hopefully I have this on the right screen. Let me know I've done this correctly. So this is basically when central banks intervened. Back September, yen did its first yen intervention in 24 years. It was sizable, followed up by an even bigger one, October 21st and 24th. All of this, because this US dollar wrecking ball, as the term applies, it got tapped down. Fed did its, Fed Whisperer, Wall Street Journal article about a pause, and that just repriced risk as well. There had already been Treasury Yellen coming out, Secretary Yellen talking about more liquidity in the Treasury market just the day before on October 12th, before the big turn, October 13th. So I see a lot of this kind of market structure of mid-October feed on itself around central bank intervention, although it might have been a little bit in disguise. It seemed extremely coordinated between Treasury and Fed and Bank of Japan, and Swiss National Bank had a $18 billion US dollar swap. And then China just started piling in with, massive amounts of growth engine stimulus and ordered state banks to stem the selling of their stock market and buy. So this whole intervention culminated in the dollar obviously topping and coming back down. It came back a little bit more aggressively given this trend line, and then tagged perfectly. That was the COVID high. This was kind of a consolidation period after the collateral, risk off move of March 2020, and then tapped perfectly at 101. And we are approaching, as you can see, this 104 area. I contend we can get up to 105, but it's not really going to shake the market until we get above that kind of Dixie 105 and hold it. A bitter tell for me is that 10-year has been percolating up, and that with exactly perfectly timed with the dollar. And the dollar yen has been moving higher. So the whole thing has been very constructive to helping equities as the dollar comes down. Bonds, however, looking terrible right now. Gold looking terrible. And then you came out with a chart of the dollar yuan, which is a little bit frightening as it relates to commodities. Let me just grab that. Talk about this chart a little bit, because I think this is also a big impact on especially reflation trades and commodities.
Yeah, and I had noted, I actually didn't send that part to you, but I noticed that we kind of, found support there at the 50% retrace and kind of started to move higher. But, dollar CNH has been a good leading barometer for risk and for commodities. And, we caught the move in dollar CNH higher last year as an inflation headwind in a big way, that April-May move, which was, a deflationary wave. And, I think what we've seen, and like you just mentioned, is this China recovery story, this reopening story, and this dollar week story really, has taken off from the mid-October levels and accelerated to start the year. I saw that emerging market flows into emerging market equities in January were, as large as they've been in, several years. So that's something that we see a lot, these beliefs that emerging markets are going to outperform in the next year. But look, I think the China reopening story is going to be a confusing one. I think it's going to be, one that's jagged, one that's, stops and starts. I mean, China has some structural issues still. It has an inflated property market. It's still kind of dealing with COVID, getting out of COVID. So it's not just a clean, run for the races. So I think people kind of got ahead of themselves in a big way there. We caught some of that with the intermarket indicators and noticing how overbought CNH had become and all the China related assets become. We flagged that a couple of weeks ago. So it's been a good move there. But now I'm seeing dollar CNH kind of, looking like it wants to break out to the upside, taking out the May highs, improving on, a bunch of, divergences. So if that's going to happen, if that's going to continue, I think, we're in a position where, certainly emerging market indices will remain under pressure, and commodities will probably remain under pressure. And, that's a concern for, some areas of strength that the tape is, has been in to start the year.
So how was your read on the dollar yen and recent action around the new sheriff in town?
Yeah, look, I mean, I think you're still in a position here where, there's not a ton of differentiation in these dollar moves. We're seeing a lot of correlation across dollar indices. And so, dollar CNH is moving, dollar yen's moving, dollar euro's moving, other emerging market, ETFs, FX is moving. So, we'll see. I think we're not going to get a new plan from the BOJ, imminently, as in the next, I don't believe in the next, couple of weeks. So I think it'll take a little bit of time before dollar yen kind of has an outsized move. But I think we are in a position where, Japanese inflation is moving higher, becoming stickier. Wages are moving up materially. And so, we could be in a position there where, as the Japanese repatriate more funds back from overseas markets back into Japan to deal and to take advantage of this kind of higher yielding environment, we may have, that may be an offset to some of this dollar strength that we're seeing. But I don't know. I still, it's a little too early to tell, but it is, something I'm watching, and we'll see that if JGB yields can have a material move to the upside here, clearly that would kind of accelerate the the bond market weakness we've been seeing, and that would provide another headwind to risk assets. It's just we may be a little bit early there, but that's the type of left tail risk that could come out really at any time if this new guy does articulate a more hawkish plan kind of sooner than expected.
I'm showing right now just a copy of a chart of this breakout higher in the dollar yuan back on April 19th. And I remember specifically because you mentioned it looks like it's going to really take off higher. And I charted it and I sent this to clients. We did reach all the way up to that 7 handle. What's different between now, what happened in April, right? Oil has, when this broke out higher, commodities were definitely under pressure. Oil and gas plays dumped, shipping plays dumped, gold, oh my goodness, careened down with a huge gap on the weekly. And in fact, just recently, literally just recently, it has filled that gap, GLD 180. This has been my premise that we would move up into that and then we would pause and roll over. I thought it would be a shallow pullback. It ended up being the day after FOMC, a very sharp pullback, and it definitely does not look done. And now we've got the dollar yuan and dollar yen pushing higher. So you had timed that breakout extremely well. I confirmed, yep, it looks really strong. What's different between now and April of last year when this did a lot of damage in the commodity space?
I think the COVID situation in China is different now. I think there really is more of an impetus to reopen. So I'm not sure yet, I guess, is the answer. I mean, part of me believes that when dollar CNH moves higher, it's an imminent deflationary impulse. You don't want to own any commodities. You don't want to own oil. You don't want to own base metals. It's just not the time for that stuff. I mean, the time of year, it's March. That's typically when China does start to improve, industrial production and activity, and brings in material. So, from a demand perspective, usually commodity demand is more robust kind of coming out of Chinese New Year and into, this February through April period. So I'm reluctant to kind of push too aggressively negative here on cyclical stuff. But the fact that dollar CNH is moving like it is, it's possible that we've run this positive trade too far. And so this is a check back this is a check back here, but it has, a lot of implications, right? I mean, to the extent that oil falls and commodities fall and inflation expectations then fall again, then we take some of the heat out of the concern about inflation. So, this is a tough one. I'm not entirely sure how to, play this right yet. Whereas last year it seemed much more obvious that this was going to be a little bit more of a headwind.
It was definitely a huge, phenomenal timing tool because both the dollar yen and the dollar yuan spiked right higher. And then it wasn't until literally the dollar yen hit 151, which happened to be a year target, and all that central bank intervention in mid-October did it fall. And market obviously got supported. Gold as well. Oil has a little bit different scenario because it's an intervention collar, as Robert McMinn puts it, because it's just not allowed to go up. And then ultimately bonds stopped falling, but now we've got the percolation of the dollar and yields moving higher on stronger inflation feel. Talk about, did I share this? Okay, no, I did share it. You tweeted this earlier in regards to a chart and then of course a descriptor. Talk about this chart a little bit.
Yeah, I mean, what I would say about the dollar also, and that kind of leads into this chart, is I think what you're seeing now is this yield and growth differential story, play out. Whereas, the weakness in October, November, and December was concerns about the U.S. growth situation rolling back over and about the Fed kind of pausing, pivoting. And I think what we're seeing now is, the fact that growth actually has held up better than expected and probably better than most other countries. And yield differentials with bonds moving like this favor dollars again. So I think we're seeing, flows back into the US. And if you have to think about just the risk-free rate is the US bond market, right? The global risk-free rate is some derivation of the US bond market, whether it's, the 6-month T-bill, whether it's a 10-year, everyone uses kind of different, things. But I mean, if you can earn, 5% in a 6-month T-bill, there's
and you can.
And you can. And, I mean, there's, with all the uncertainty in the world on growth and inflation and, the various, things that are going on geopolitically, you have to think about, where else would you like to put your money that could do better than that risk adjusted? And I think, we are getting to that point where 5%, 6-month T-bills and, marching higher, it just feels like a safe place to be. And if you want to invest in China, or you want to invest in other markets, you really need to get, materially higher returns. And the PBOC is cutting rates or cutting reserve requirements. It's just not, I don't think capital is necessarily going to, be attracted incrementally into China at this point, even with maybe some recovery on the growth side. So as far as what I tweeted earlier, there had been, I think everybody now, we've been talking about this net liquidity idea for months. Various other market participants and FinTwit has been talking about it for a while. There's this idea about the correlation between S&P and Fed liquidity as defined by the Fed balance sheet, less the Treasury general account and less reverse repos. And there had been a growing divergence of that performance, over the course of the last several weeks, where the net liquidity indicator has continued to decline. But S&P has moved materially higher, and I think
I want to show that liquidity chart. Did you send that to me, by the way?
That's what you had up. That was that tweet. So the tweet that I had put out was that. That's
okay.
So you just had it up there before.
Got it.
And so what I did was I put the DXY on top of that chart, and I think what you see is that even though Fed balance sheet, the green line moving lower, has been moving lower. That's an element of liquidity. The white line S&P has diverged from that, and that's been driven by this move, lower. And that's the purple line is inverted, right? So The purple line moving up is dollar weakness. That had been the driver of this S&P move. Now that the dollar is rallying again, purple line down, I think that you have a situation where the S&P catches down again to the net liquidity indicator. So that is what I was trying to articulate there, which is I think what people have been missing with the just looking unilaterally at this U.S. liquidity situation. And I think there's been some other charts about BOJ has added liquidity and PBOC has added liquidity. That's happened. That's obviously helped as well. But I think both of those, start to peter out here, too, with this dollar rally. And I think we'll get a catch down, at some point imminently with U.S. indices moving down as well. And we've already started to see it with some of the emerging market indices and maybe some of the European stuff. I haven't seen it yet in the U.S. because of this, the zero DTE call buying craziness that's continuing. But
yep,
typically that doesn't last forever. So
let's talk about some of that liquidity stuff, because there's a lot now of emphasis on these liquidity flows. And for years I have used a kind of a particular indicator or set of indicators to track liquidity intraday, daily, weekly, but it's very much focused on market action, right? So this net buying and net selling. Now folks are very, very focused on Fed liquidity. Some call it overall liquidity. Others are tracking central bank global liquidity. In other words, a lot of folks are now focused on this because it's very clear that as it was going up, so was the market, and as it's going down, so should the market. But we've had this divergence, right? And so the bet is many are bearish as it relates to catching down with liquidity. But this is a trick because the flows don't come out until Thursday. So you never really know precisely how they're going to hit, and the week's already done. So how do you use liquidity really from a trading strategy?
Right. Look, I think more people have gotten more sophisticated, and there's definitely some more people on Twitter and Substacks who are trying to forecast this. And it's not. You can get into the weeds. And you can go through like today's the 15th, so it's a big quantitative tightening day. There's a lot of maturities. I think 70 billion of maturities today. But really, what you're trying to identify is you're basically looking for the measure of bank reserves. So bank reserves are, what's in the banks that could be used as, a vehicle to allow for leverage for funds to kind of invest in speculative assets. So, basically what you have is you get the Fed's balance sheet and you get bank reserves every Thursday afternoon ended Wednesday. Okay. The RRP, which is funds that can go to be lent to the Fed overnight, you learn that data point every day. And as far as the Treasury General Account is concerned, that's the cash that the Treasury keeps at the Fed. You get that every day, also with a day delay. So there is a little bit of a way to, kind of forecast this. But I think now that everyone's really, really focusing on it much more, it's probably the utility of trying to nail it to the day or what have you is not as useful. Basically, the biggest variable in any particular day is the reverse repo facility, and that's ultimately a decision that individual banks or individual investors are making kind of in real time about where to park very, very short-term cash. And so, as reverse repo yields have risen commensurate with interest rates moving higher, more individuals have taken money out of banks and put them into money market funds, and those money market funds then invest in the RRP. So bank deposits, and this is something the Fed guy wrote a bit about this week. Bank deposits are yielding 50 basis points. JP Morgan, there's no yield on banks, on savings accounts and on checking accounts. So in theory, money should be flowing out of JP Morgan's reserves, out of those checking and savings accounts, because you're not earning any yield on it. You could put that into one of their money market funds or put it into any money market fund and earn 3, 4, 5%. So there's a drain on bank deposits, and that money is going into the RRP. So, that's one element of this, but I think ultimately it's about risk taking. It's about the desire of individuals and institutions to engage in risky behavior. And so today there was a big drawdown in the reverse repo facility. Why? I mean, markets are markets have been up. This tech rally has been strong. There was a very big Amgen had a huge bond offering today. There was 100 billion of demand for 25 billion of supply. So look, it's about risk taking on any individual day. But broadly, over the course of the year, the Fed is engaging in quantitative tightening to the order of 90 billion a month. Treasury, hold the debt ceiling aside for a moment here, should not be adding or contracting, incremental liquidity. They've drawn it down over the last 3 months. As the debt ceiling is drawn closer, they could draw it down further. That could be a tailwind for liquidity, but then it becomes a headwind later this year when Treasury will issue more debt supply again. So, but fundamentally, bank reserves are falling. That is pressure for risk assets, all else equal. I think that's really kind of all you really need to know. And trying to just trade that chart and when that divergence is gonna close, I think is a challenging, it's become a challenging game. But I think it shouldn't detract too much, right? That we shouldn't see material gaps kind of exist for long. So I suspect that there'll be an event or something that kind of brings those lines back in order.
I'm actually showing a chart because there was a question. What's the flow looking like from carry trade perspective out of Japan? And I just grabbed this in kind of response to that. This is Bank of Japan assets, which obviously picked up in earnest when they started doing the yen intervention September. What did I say? 21st? No, that was October 21st, 24th. Anyway, and then again in October. Okay. Point is that obviously helped with other central banks joining in, right? China as well with fiscal stimulus and the rest. But the question is, how much of that makes it out in the global markets, equity markets, bond markets, versus this kind of yen staying home thesis of more stimulus that's done in Asia to kind of offset, even though it triggers more inflation. They've got much higher inflation. Australia and Japan is percolating very strongly there as well. And, biggest prints in 40 years. The point is, how do you kind of extrapolate what the QE effect is on global markets when they're attempting to keep this at home now, more of it at home?
Yeah, look, I mean, it's not easy to do, first of all, and then you get this tick data, which is kind of foreign holdings of U.S. assets, and that comes with, I think it's a 2-month delay. So
yes,
so the data that we're going to get shortly is data that was existing, I think, at the end of the year. So it's already, or maybe even the end of November. I forget. So you're either 6 to 10 weeks behind in kind of this official data. So you get a read on what happened kind of in the past, but you don't exactly know where things are going specifically now. But I think from here, it's clear that the BOJ adding to its balance sheet to kind of support the yen and keep yields at bay has been a positive driver for liquidity, and that dollar weakness has assisted risk assets. I think it's
absolutely
very clear that that's happened. So from here, is that going to continue at the same pace? I think that's unlikely.
Diminishing returns. I mean, they have spent a fortune literally in trying to backstop their bond market, and now with wages percolating higher over there significantly. So I think they have risk of a little bit wider yield curve control. And that's one of the reasons why I recently, I've been watching this gold trade, right, fade at that high point, and really thought it would be a shallow pullback. It was much, much stronger. It almost seems that it has a lot more to go, especially with the dollar yuan now percolating higher as well. So that could be also head and shoulders, big picture. But for right now, I'm remaining definitely on the cautious side that gold is not done falling. Explain this chart, if you would, because we were just talking about commodity and
so
impact.
Yeah, but now that SOFR rates have kind of taken over from euro dollars as the kind of metric for Fed rate hiking. I mean, basically what you have here is the white line is effectively the market's expectations of rate cuts for December of 2023 versus June of 2023. That's
much better.
It's H versus Z. Yep. So up until, a month ago, or not even up until, 2.5 weeks ago, the market was looking for basically, north of 2 rate cuts this year from December versus, let's say, June. The Fed had said that they expect to get to terminal rate, whatever that is. They had said 5.1%. Clearly, there's a bias for that to be moving higher, and that they would stay there throughout the course of the year. The market was calling BS on that. Said there's no way you're going to be able to do that because we'll be in a recession or whatever it is. So what we've seen over the course of the last 2.5 weeks since this trifecta of US better than expected data has come through is this white line has moved up to, I guess that's 8 basis points. That was this morning. So effectively we've priced out those rate cuts. So the market really is no longer looking for an aggressive rate cutting cycle to begin imminently. Once the Fed has reached terminal rate. The other thing too is at the beginning of February, the market was thinking the terminal rate would be achieved in May. Now it thinks July. So we pushed that out, two meetings as well, and we pushed these rate cuts out. So the chart that I had there really just shows that a big gap has opened up between this cutting cycle being removed and the dollar. And so I think for me right now, the most variant view is dollar strength coming imminently as FX markets reprice aggressively this move in the rates markets, and as the rates markets have priced in kind of a U.S. economy that is better than expected with inflation stickier than expected. There had been an expectation by the market that CPI would return to very close to 2% in June. That's moved up to 2.8%. So
right. And Lori Logan is out talking about how they might have to move the goalpost of 2% to 3% in time. Did you have a comment on that? By the way, this is the yield curve 2 and 10. Wanted you to just comment. Obviously, it's very depressed. What is the bond market, kind of intonating with this lower for longer, which is obviously higher for longer in yields. But
yeah, it's we continue to kind of push these curves into deeply inverted territory as the bond market, is believing that, well, the Fed's going to have to take short-term rates up even more in order to slow down this economy and slow down the inflation and slow down the labor market, which is the leading indicator for wages, to get core services inflation down. So as the Fed is forced to take rates higher, that increases the likelihood of a hard landing. And so, that's what the 10-year is more worried about. And so that, this tightening of rates is going to lead to a more drastic growth slowdown later. That's why curves are getting even more and more inverted.
I believe that, by the way, like this finally is catching up, right? This new narrative, if you will, of a higher peak terminal rate. I think you and I were both laughing when the market was pricing in rate cuts. We're like, no. So the continued rate hikes, they remove liquidity. We've kind of shown these the flow, if you will, of liquidity charts, which is this type of thing, right? Up the mountain. Overall liquidity, we're coming down. Even if we have these very sharp bear market rallies, we're still highly suspect on that whole move. And then, of course, this depressed inversion, which stays there, helps to strengthen the dollar. I had a chart of the dollar up, which was basically just showing that it still has potential for a little short-term bounce. It can still base here for a while before moving higher, but it's still a very strong chart. And then if we do have this continuation of yields moving through, let's do this right here. This is obviously the 10-year kind of inverted. This is SPX. There's quite a bit of a divergence. At some point, I think this is going to be the issue. We had this fall in the dollar through a lot of central bank intervention in mid-October, but yields also followed. So we get back up to that 4.33 because we literally fell 100 basis points in the 10-year from 4.33 to 3.33. And that 3.33 was very strong support, which is why I was very bullish for yields and dollar. But this particular bounce still has to prove itself, right? But this to me is getting closer to that event of triggering higher into that 4.33 again, which will trigger that emerging market panic, definitely a rotation out of tech again, kind of that third leg down thesis that I have. I think we have one more good third leg down in tech this year before it's really safe. Not to say this does not have a fabulous momentum rally at play, but even today it was a lot of the, a lot of junk. It's still chaseable. Bitcoin is still rising. And in fact, you have a chart of Bitcoin that I want to put up if I can grab it as it relates to.
Yeah,
No, that's not it.
Yeah, that's it. I think that's it, isn't it? Yeah, that's XP. Yep, that's it.
Oh, it is. Okay. All right. So explain this one a little bit. Sorry if it's a little bit.
Yeah, so I think what we're starting to get now, and it was accelerated after the CPI print, is a resurgence in inflation expectations kind of moving higher, and these break-even yields as a reflection of where forward CPI will be have bounced aggressively since the beginning of the year when they were kind of sub 2%, and now this 1 year inflation expectation yield is up close to 3%. I mean, there's a lot of that has is driven by energy, but there's more more to it. And so I think what you have is Bitcoin kind of acts as a kind of does better when inflation expectations are going up, as people start to believe that there's going to be more inflation in the future. Bitcoin is a kind of pro-inflation asset. I think, frankly, some of the stuff we're seeing from ARK and tech and stuff, I think also is probably kind of mixed in to this inflation expectations moving higher. I think the market is just trying to find things to own if inflation is moving back higher again. So, and since commodities kind of went first and with the China reopening, and that kind of got a little bit ahead of itself, maybe some of that money is now rotating into tech as a some sort of way to play higher inflation expectations. So for me, one thing that I had been we haven't talked about financial conditions yet. And
That's true. Yeah.
There had been a big discussion about financial conditions into the prior Fed meeting, and this idea that financial conditions had been loosening aggressively, and is the Fed going to push back against this? And I thought that they would, and I think the mistake that I made there was that financial conditions had been loosening, but inflation expectations were also continuing to move lower. That has now stopped. So now that inflation expectations are moving higher again, it's harder for the Fed to say things like inflation expectations are well anchored. And as they start to see the data re-accelerating, whether it's headline or core, that means that this loosening of financial conditions we've seen has probably gone too far. It means that, because they've allowed conditions to get so loose, there's been animal spirits that have resurged. I mean, this realtor housing in the NAHB survey this morning, what was a massive beat. It's still it's still under 50. It's a diffusion index, but it's a huge bounce off the low, kind of the biggest month-on-month changes that we've seen in several years, as people have started to kind of get more comfortable thinking about buying homes again because of the belief that the Fed has, slayed inflation, mortgage rates are lower, long end yields have come down. And so kind of this little subtle financial conditions loosening concept, which the Fed has said, oh, we don't, that hasn't really happened. It actually has happened, and it's kind of showing up in the data. So I think from here, as inflation expectations move higher, that's something that the Fed is not going to want to allow to get out of control. And so I suspect, I mean, we have 4 or 5 speakers tomorrow. You have the minutes are next week. Powell speaks again early in March to Congress. I think on the margin, you're going to hear more about a Fed that is looking to bring its dots up, not down. I think it's interesting here with Brainerd leaving the Fed.
I was going to ask you about that.
Yeah, I think, but she's a very well entrenched, leader of the dovish camp. So I don't exactly know who's, going to be spearheading the call for dovishness as much anymore with her gone. But importantly, also, her dot is gone. And we also
her dot is gone.
Dot is gone from the dot.
Who will replace her dot?
So in the meantime, and for now, nobody replaces her dot because it just kind of goes away until they replace her. We also lost Esther George is gone as of the end of January. So you lose her dot too. So assume that George's dot was probably a 5.1% dot and Brainerd's dot was probably a 4.9% dot. I know this is kind of inside baseball type stuff, but you basically had, you had a 12 Fed members who were looking for 5.1 or lower and 7 who are looking for 5.4 or higher. So you've lost 2 of the 12. So now it's 10-7. That means you only really need 2 of the 5.1 dots to switch their views for the dots to go up at the next SEP meeting, which is next meeting. And I think that's a very easy task given the data that we've seen. I suspect Bostic is going to move. I suspect Waller is probably going to move their 5.1 dots. There could be others that move. So I think we're going to hear more. I mean, we hear from Mester tomorrow. I think she is the high dot. I don't think she hasn't come out and said it, but I believe given the Cleveland Fed's work on inflation, I think she's the high dot at 5.6. I think we're going to hear more about, from her tomorrow. She speaks twice. And after this data is, and after the Cleveland Fed trim mean showed a reacceleration of inflation, I think she's going to, signal a very hawkish message. She is not a voter this year, but, obviously very well respected kind of hawkish voice. Bullard speaks tomorrow too, similar thing. So I think we're going to hear more from a Fed that is looking to kind of bring the terminal rate up again as we head into the next meeting, which, based on my framework, pushing out the timeline towards Fed liquidity is dollar bullish, risk bearish. So
we haven't gotten the risk bearish yet. This momentum rally hasn't run its course. It has been very strong off the January 5th bottom, no question.
Yeah.
And I don't see the turn yet, right? And so that's all I care about, right? I can see the petering out, February 2nd, excuse me, a little sideways in breadth, some very big divergences in breadth between price and the breadth action. And of course, net buying really hasn't turned into selling yet. So there's not just short covering, there's actual natural buyers in this market since not just I'm not talking about October, intervention, but that momentum rally that we've had, that thrust that we've had since beginning of January. So all these dots are moving higher. Fed rate hiking expectations have now been extended, whether it be 50 basis points or 25 for longer. When do customers at a bank start to see this? Because there's actual implication for that, right? So right now banks are paid, customers aren't for this higher yielding cash deposit. When do customers actually get theirs? And what would the impact be on the banking, kind of like the trade, if you will? Is that the time to short banks when they start to actually put it out there that they charge some nice high interest? You don't have to go get the T-bills. We got it right here for you. Well, what's your call on that whole dynamic, the plumbing, if you will, of when customers will start to see it in their accounts?
Yeah, look, you already are starting to see it to some degree. Like, I mean, let's just say anecdotally for me personally, and you can see this in the data, like I have, pulled my money out of, discretionary money out of JP Morgan earning 0 and participated in T-bills auction. Yes. And so I think, and you can see that in the T-bill auction data, more and more individuals and more people are doing that. So that is a flow that's coming out. You also see some of the online banks and smaller banks have started to offer higher yielding interest accounts, right? Marcus and other these ING bank and all these other banks, they're in the 3 and 4% range, and JP Morgan and Bank of America and Citi are still in the 50 basis point camp. So there's still too much liquidity, which is why the banks don't need to pay up for deposits.
But Main Street is still not seeing it. I mean, I just had the HVAC guy here this afternoon, knows what I do, and says, when am I going to see it in my savings account?
and I think that there's no JP Morgan, the big banks are still flush with cash. They're still flush with deposits, and they're not. And you see by the C&I lending stats, tightening of lending standards, they're going to be slowing down their loan growth next. So they don't need as many deposits to make loans because they're not making as many loans. So if they don't need as many deposits, they're really not in any, and from a regulatory point of view, they're in fine position. So they're really in no race to bring up deposit rates. They don't need the money. They really don't need the money. They still have the big banks have excess deposits. Well, you'll see it is in smaller banks that maybe have some exposure to bad loans, and they start to have to take up their loan loss reserves. They need more deposits. They have to go and bid for them. They could go to the RRP and start bidding for these deposits by offering higher savings and try to attract capital out of the RRP to get into the banks. I think where this is important is how it pertains to the duration of QT. There had been some discussion that maybe QT, would end sometime in the middle of this year because, bank reserves are falling at a rate that, maybe become concerning to the banking system. And I think what Waller and Logan had both said in recent speeches is that the market should be thinking about total level of bank reserves plus cash available in the RRP as this kind of aggregated amount of money that is still in excess. If banks want to, it's still way too much money. If banks need reserves, they could go to the RRP and go get them. They could pay up basically by what that means is they could raise their savings rates to attract capital if they need it. They can't go and complain to the Fed, we don't have enough reserves. The Fed's saying there are plenty of reserves still out there. So people who had been thinking that QT was likely to come to an end sometime this year, I think are going to be very, very disappointed. Logan has said this will go on for a couple of years. She is the architect of QT. She ran the New York Fed's SOMA division. She created this QT program, at the New York Fed. So I think what she says on it is very important. Waller has said similarly. So I think from a liquidity point of view, they've also both said we could be in a situation where the Fed is not raising rates and may actually even be cutting rates, and the balance sheet can continue to contract.
Okay, so what is that in realistic terms? Since you just mentioned Lori Logan as a kind of architect and very respected outside the Fed, now inside, right? Sitting in the boardroom. What about her comments recently of inflation benchmark rising up from 2% to 3%?
Yeah, I think her comment
that's really not priced in. That's for darn sure.
Look, I think that I think her comments were more along the lines of if you run this math that the market is doing right now, the Fed will not be successful in bringing down inflation to 2%. And so I think what she's saying there is we need more hikes in order to take inflation back to 2%. Various Fed members have been asked this question about changing the mandate from 2% to 3%, and to a man or woman, they are all saying the same thing, which is that is not on the table. We are not shifting the mandate from 2% to 3%. We're going to get back to 2%, because the minute they say that they're not going to, that they're going to change the goalposts, they completely lose credibility, nearly instantaneously. So I think it's more likely that we will be in a situation where they get us to 2% first, and then in the next 5-year review, which happens, I think, in 2025, they consider, another path maybe towards, 3% or something else. But I don't foresee that as something that is tradable in this horizon, where we should be thinking about an inflation rate that stops at 3%. think we should be thinking about an inflation rate that stops at 2%, and that the Fed will be successful in getting us down to that point at minimum, so it can make the argument later about why it wants to move to 3%. Right. So
Okay.
I don't view her comments as something that is something that's tradable, or something that's a change in mindset. I think it's more of, the job is not done when we get to 3. The job is done when we get to 2. And in order to get from 3 to 2, we actually need to be doing more, or we need to be holding for longer.
Okay, that's excellent. I think that sums up really well kind of the why and the who and the what. We don't know when. That's really a good question that some folks are asking right now. We've got a few questions in here, specifically as it relates to this rally, since I very much focus on kind of 3 main legs of the table, which is liquidity, which I deem as net selling or buying, as it relates to kind of timing market direction and the strength of a move, literally the intensity and the duration of a move, also the dollar and yields. Now, right now, the dollar's having a perfectly timed bounce with yields, perfectly on a technical support level, right? Both that was set up. We were like right on that. Now we're going to really be tested, because if they break above, and I'm not in that camp yet to say firmly, yields have definitely threatened to move back up into that 4.33 level, where markets started to get very shaky right before that whole mid-October central bank band got together. But they're definitely intonating higher, right? 3.9, 4, inch by inch by inch, especially as the narrative flips. Dollar is the same thing. It's definitely bouncing on a key area right up into that 105. We could get 106 and it could get tapped back down again. So I know you're a dollar bull. I know you're a rate bull. I know you're a liquidity bear. Put all that together, you're not alone, but there are no signs right now, right, that the bulls are looking to exit into the safety of a 5% T-bill. They're still chomping at the bit for some nice, oversold bounces. And the CTAs, you talk about that a little bit right now, because CTAs have been one of the reasons for the season, not just short covering and natural buyers, but also CTAs. What does it look like in that world, since quant is such a big component of market structure? Where are we at with duration of this current rally and CTA involvement?
Yeah, well, as far as CTAs are concerned, my understanding, just from kind of reading the stuff that JP Morgan puts out and Nomura puts out, it sounds like CTAs are basically all in long equities at this point, and would become kind of aggressive sellers of stocks kind of below 4070, and then certainly below 4,000. That would trigger kind of a massive selling wave. So, I think the question is, well, why haven't we seen it yet? Everyone's kind of asking, the same question. I mean, if you look at some of the international indices have been weaker as the dollar has rallied. I mean, EEMs are 6.5% off the highs. China stuff's is off the highs. So we're starting to see some of the breakdown abroad. The only explanation that I really could come up with for why the U.S. indices continue to be as robust as they are is that there is still too much liquidity around, and the 0 date to expiry phenomenon of buying cheap calls and forcing gamma squeezes across indices and across single stocks is obfuscating the truth. I mean, 0 date to expiry is 60% or more of volume now on a day-to-day basis in the option market. I mean, it is the biggest determinant of everything.
Mm-hmm.
And so what you have is, it's not just retail, it's institutional, algo, quants, everybody, people who are machines, and real players who are kind of buying daily options at various strikes, and trying to force dealers to delta hedge and squeeze higher, and we'll kind of let the chips fall where they may. And so that flow is a flow that is new. It's a flow that is, as we discussed, is not particularly regulated in that you can kind of trade zero data expiry options without having to post collateral. So there's kind of unlimited margin on this trading, and it's kind of taken, it's taken trading, it's taken kind of daily, market by storm. And that's why we have a situation where we have, and I think I saw something from Jim Bianco, we've had like 20 intraday moves of 1% or more in the last week or so.
I mentioned that as well.
And yet the VIX is on the floor, and the VIX measures 30-day vol or 25 to 30-day vol. If you believe that zero data expiry puts and calls are just going to keep kind of overall moves contained, I guess I understand why, the VIX is not really moving. So I don't exactly know, when this will shake. But here's an interesting anecdote that I just kind of learned, today. So yesterday I saw, Silvergate, which is the, kind of crypto bank, right? Four different actors filed 5% positions on Silvergate yesterday. Those four actors were Citadel Securities, Susquehanna, Group One, and Jane Street. Those are the four biggest option players basically in the market. So why do the four biggest option players now collectively own over 25% of Silvergate long? It's not
look at Mara.
Really all they're doing is they're being forced to buy stock to hedge against the call selling that they're doing. So these companies now are having to file on companies that they don't, so I don't exactly know like how long this can go on, for. I mean, but Silvergate's 70% short interest. It's a $700 million company. It's not that big, but we're talking about now these four option players have a $200 million combined position in this company that because that's the hedge that they have against the short calls that they have basically for this week or for next week or whatever it is. I suspect that's going on with Tesla and NVIDIA.
It is going on, like Mara, a Bitcoin proxy has a large stake by Soros, BlackRock, and Vanguard. I'm not quite sure the Soros thing, but
I think it's
they're
more
getting sponsorship.
But I think it's more important where we see these option players when they're being forced to file on names, right? I think Silvergate was up today because I think people thought Citadel was buying it. Citadel Securities is who owns it, not Citadel Advisors. Citadel Securities is the broker dealer. That means that their options group is short calls in size against this position. And that's why they had a file of 5.1% stake. So collectively, those four players now own 25% of this company. I suspect this is going on all around. So dealers are going to have to make it more expensive for zero data expiry players to keep doing this. At some point, zero data expiry call buying will lose money, just like it did with the meme stocks, just like it did in early 2020 with Tesla. It takes time for this to play out. Maybe it'll be something from the Fed tomorrow that kind of pushes the terminal rate up even more. Maybe it'll be a Russia headline over the weekend. Like we really don't know, right? I mean, so
yeah. So I want to show a chart though, because I've been using this as a guide, but yeah, we really don't know. I mean, we do have, potential escalation by Russia just on the nature of their, February 24th anniversary. There's rumors, and then there's, I don't know, it's a geopolitical risk for sure. But as it relates to the momentum of this rally, there's no question, at least just from a sector rotation look. And I was on the lead lag report talking with Michael Guyad about this. We could see that there was a rotation, very, very strong into the growth sector. For me, it was January 5th, and it just continued higher. I actually thought we were going to get a pullback last week, more than the 40-50 that came in, and we just got defended again. But then you're just explaining so well why the Silvergates of the world are getting defended, right? So they're the zero DTE and the sponsorship behind the scenes. A lot of this is still in essence short covering, but this has not come back down. So I'm basically using this as a kind of a signal of strength. even though we do have momentum, which is starting to fade, but we haven't rolled over. And I do this across so many, right, as far as breadth and, cumulative volume and sector rotation, and the rest. And we really just do not have the falling market in the indices. This, however, is gold relative to the dollar yen. This happens to be very clear that it falls as the dollar yen percolates higher. That's been a pretty clear bet. Oil, because I got asked about that, so let me just kind of go over that real quick, is just a sideways snake. So I don't see anything really high probability here as an inflation hedge. I definitely don't see gold as an inflation hedge right now. That's as I said, very much reacting to this inverse dollar, but higher Asian kind of FX currency risk. But oil is nothing. It's just really, really sideways. We've been waiting and trying to get a nat gas to base down here, and it still has not performed in a bullish way. So I had a question. I don't know if you saw that, Craig, about nat gas, and there was a very particular kind of flavor to that question I don't have an answer to. So if you do have any insights, but this is basically what I'm much more focused on is yields and dollar, right? So this is the T-bond futures. We have not been able, since that mid-October intervention, bonds stopped going down. This is true, had a very nice move. This is a daily, by the way, and a weekly. Big picture though, that is just a busted 40-year chart. You can't even see it because I only have it on the weekly. So it is completely busted, complete breakdown, literally rallied into resistance, a 40-year trend line collapsed. October got support, and it still can't even get above this 131 for ZB T-bond futures. And it's rolling over very, very nicely, which means yields are going higher. The dollar is really the reason with yields as far as the season, and we're going to have a shock if this gets back above 105. Again, this is a weekly, that's a daily. And as this kind of percolates higher, gold is no bueno, precious metals. We've seen copper come back down, but for the most part, I just am waiting to see what happens, because this could very much be that kind of right shoulder, and it gets rejected and pushes back down and takes out the prior lows. That'd be dramatic. Otherwise, we're just going to be kind of in this zone here for a while it figures it out, in the same way, honestly, that bonds are trying to, I guess, discover whether they have a recession or not. But any kind of final thoughts on dollar and yields, because that's really the reason for the season in a lot of the trades. Oil, I just think, is a very different beast, and is not going anywhere fast.
Yeah, I mean, I think we're going to keep, like I said, I think we're going to keep getting data for January, coming in the next, week or so here, that is better than expected. And it's going to continue to cast doubt on an imminent recession call, and on that the Fed has done enough to arrest inflation. And so I think that continued surprise in data, I forget if I had that chart from earlier, but I put up a chart of the city surprise index versus the terminal rate, and there's a very tight correlation. As the data beats and the surprise index moves higher, the terminal rate moves higher, not surprisingly. So I think that's what will continue to happen here. I think, Fed speak over the course of the next couple of weeks will signal similarly, which is there's risk to, needing to move rates higher. So I think that dynamic of rates up, dollar up, creates a challenging narrative for equities, which, frankly, have already seen a negative earnings revision cycle start, right? I mean, these companies all just reported, earnings for 2023, I think we're, forecasted 235 to start the year. They're probably closer to 220 now. And that was with rates lower, right? I mean, that's kind of as of the fourth quarter, as of calls from a few weeks ago. So it's not clear to me why people believe that, earnings are now going to reaccelerate here after they were just, pretty bad. So I think there's the negative earnings revision story will continue as we move through the next few weeks. I think this retail sales number we got today was, it was fine. It was good. It was a reacceleration after a terrible December. A lot of that was just nominal, right? Inflation was higher, so retail sales came in better. We'll see if that really continues. Obviously the PMIs have not been particularly good. So I think the jury's still out on how robust is this economy. But I think for now, better data for January because of the weather, whatever it was. Claims continue to be low. Labor market robust. Wages up. Core services inflation up means Fed is pushed out before it can loosen, which is dollar bullish. Yields up. Stocks should be down.
They should be down. And I've got a question. And I said, more important question is if markets start to price in the rising yields, how low could SPX go? And it's a great question. In fact, because as we've done in the trading room, and, I've talked about if this continues, in other words, 3.33 was my line in the sand. It was 3 levels of support. We would get a bounce there. It was inflationary. If we dropped below 3.33, it was deflationary. I've written about it. I've talked about it. That was just my technical line in the sand. So basically extracting out for this year, again, if we continue to move higher, which looks more and more likely, 5.13% in the 10-year is actually my price target, right? That translates, and I didn't know this, by the way, I was sent this chart. It translates to about 2,700 in SPX, depending on a 2% operating cash flow. And that's basically how kind of Bloomberg figures out where to give their pricing, market pricing, again, earnings compression and the rest, and growth. And I loved how you were talking about with this move in terminal rate higher, pushing rate cuts out, it feels close to something big happening. And as we were talking about this, because this is a few days old, actually, it was February 8th. It's now the 15th. Yields literally have followed through. So that is very big. But this is the chart, Zon, and I have no idea how accurate it is, because again, if 10-year gets to the 5% level, right, and we only have a 2% growth in operating cash flow, then that's their estimation, okay? Really, right now, at the time that this was done, yields were down in the 3.5%, and they still expected a lower print for the year, depending on this cash flow. And then, talking about earnings, I continue to see this recession in earnings play out. It peaked, right? Past peak valuations, but peak earnings. It peaked in July 2022, and it can take 2 years for this thing to kind of settle and move lower. So that chart is a different one, but talk a little bit about that price target to 10 years.
Look,
It's really tough.
Even think about it from this perspective. At the low in October, the closing low was 35.77. 2-year yields were 4.3% versus 4.60 plus today. Peak Fed funds rate was 4.66 versus 5.27 today. 2023 estimates were 235 versus 220 today, and the Fed balance sheet was 300 billion larger, right? So yields are higher today, terminals higher, earnings estimates are lower, and the Fed balance sheet is lower. And the market back then was 3,600, and now we're 4,150. So I don't know. Can we get back to 3,600? Based on everything that we're doing. I really don't see why we can't. So is that an imminent going to happen in the next week or so? Probably not. But I think as we push into March and into the March Fed meeting, and we are talking about a Fed that is likely to take dots up, and we're likely to see probably more recessionary data eventually come in again, right? The city surprise index is good because at some point it gets to an elevated enough level where the street starts to walk up their expectations for growth, and then we start to miss. So now we're getting towards the high end of the range on positive surprises. Eventually that'll roll back over again. So I think as we're maybe coming into the end, middle of March or into the end of the first quarter, early second quarter, as as earnings don't really come through, as inflation is stickier, and as growth continues to slide without a Fed that can accommodate, that is, maybe an environment where we can start to see those those materially lower.
But we need to see yields and dollar higher to cause the
That's right.
animal spirits to kind of go back into the closet or hibernation. And this is the chart I was just referring to in regards to gap SPX, which has peaked in July and is rolling over, and it has more work to do just in regards to the downgrades and in forward SPX. I think this is it's still working its way out, because they're still passing along prices and making it up there versus volume, and wages are still rising, and so far they're still pushing it through. Like you said, lots of liquidity still in the system.
I think Nick Timmer said it was on an interview last Friday. I thought he made just a good point, which is they asked him about this no landing scenario.
Mm-hmm.
And he said a no landing scenario is really just, a hard landing deferred. There is no such thing as a no landing. The Fed has told you they need a landing, right? They need to bring inflation down. They will, allow for the unemployment rate to rise in order to bring down inflation. And so to the extent that we are pushing out in time, when we achieve that landing, it just means that they're going to need to do more. So I don't subscribe to a view that you can own, equities here on some, no landing scenario, that earnings are going to magically reaccelerate. That the consumer is robust. I think this is, more of a false dawn here. I don't suspect that that's how it's going to play out. I think the Fed is going to be resolute in achieving this mandate of bringing down inflation, and that if they need to take the economy into something more sinister than is being believed, then they will.
How about the spending cap battle coming up, and the risks, if any?
Yeah, I mean, this is very difficult to handicap. I mean, you are dealing with, and this is not a political statement, but a Republican Party that has proven to be, intransigent, and one that does not like to negotiate. And there's a wing of that party that I think is, fine burning the system down in a lot of ways. So I'm concerned that they will take this, to the end. And that would be a total catastrophe. So hopefully cooler heads will prevail. I think there are some people who believe that the path to that point where the Treasury is forced to draw down the TGA from 500 billion basically to zero is some sort of risk on event. I really don't see it that way, and that's not really how it traded in 2011. When we got to the brink, yes, it is a release of liquidity, but markets are forward looking. The amount of spending cuts that will come and the risk that they actually screw this up, I think will dwarf any liquidity release that comes, from the TGA being drawn down from 500 billion to zero. So I don't view that like this as some counterintuitive. The closer we get, the more Treasury releases money, the more likely markets are going to rally into that. I don't really see it that way. Markets are really forward looking. The bond market, short-term funding is going to get very dicey as the bond market starts to think about maybe default in 4 weeks, 8 weeks, 12 weeks. T-bill auctions are dependent on that kind of understanding, and there are money markets are not able to invest in defaulted securities. So they're not going to, if they think that there's a risk of default in an 8-week T-bill or a 12-week T-bill, like they're just not going to show up to invest in that. So I think that risk will overwhelm any bullishness that would come from this draining of liquidity I'm sorry, this adding of liquidity as the TGA is drawn down. But
And is it my understanding that that's supposed to be a bull? And I have an opposite view. Obviously, I think March is when we're going to have fireworks, but the TGA is whatever direction it's going to be bullish for March for the market.
There is a belief that is the case.
Okay.
So yeah, the Treasury has said that they expect cash levels to be 500 billion at the end of March and 500 billion again at the end of June. People believe that as we get closer, that 500 billion can go to zero. And that is money that comes from the Fed into commercial banks, that adds deposits, that adds liquidity. And so that's why it's bullish.
Okay.
So
I have a different timing mechanism that's completely separate from that whole TGA estimation exercise. And it says bearish risk in, around March 20th. So we'll see if that comes. I've been talking about that for a few months.
I mean, both Treasury and CBO and other market players have said that the US should be fine on bills, paying its bills, through June and maybe into July. I think there's maybe some risk that if tax receipts don't come in as robust as forecasted, that maybe that gets pushed up a little bit, but it's not, I don't think we're dealing with this in March. I think we're dealing with this more in May, June, July than not.
I think personally, I have been steadfast that March, and I still don't know what's going to be the trigger, but I just happened to read, speaking of the zero DTE option drama, it's a tail risk that is not being priced in because obviously there's nothing here that looks bearish, but JP Morgan's Kolanovic just said notional amount of volumes for the zero DTE options is about 1 trillion. That's huge. We're talking on the daily, right? So there's a massive amount, and he warns basically VOLmagedden as dealers may not be able to deal with these options as they do never get in the money, creating volatility suppression. So an answer to whoever just asked about who exactly loses on the zero DTE trades and how does it eventually end. I see a question, I go look for the answer. That's just how I work. That's basically it's they never get in the money, creating volatility suppression, which will trigger, he warns, of a sudden 10% drop. So
yeah, but I think what you need some sort of piece of information that maybe comes out of left field that catches people off sides, in an overnight session or over a weekend that.
And they're not hedging.
Right. So
folks are not hedging.
Right. Because VIX is not paying. So you're not really seeing hedges out the curve. Obviously there's an expiry this Friday. So a lot of your monthly hedges are off the table, are being removed. So what you would need is some sort of kind of, semi-exogenous event that catches the zero DTE call buying crowd off guard and maybe even forces them to switch to becoming a put buying crowd. And then you flip this on its head, and then the put buying begets more dealer hedging to the downside. I know there's also, JP Morgan has these big hedges out there. There's been speculation about where Icon's hedges are, different levels, 40.50 for this Friday, 35.950 for regular March expiry. So those levels then become kind of, gamma squeeze levels. And, you could kind of create this, 1 + 1 + 1 = 10 type environment where, everybody is forced. And look, I mean, not to be, overly, sensational here, but this is pretty much how the 1987 crash happened, right? I mean, you had portfolio insurance, zero DTE kind of acting like portfolio insurance. And then all of a sudden, the data starts moving in one direction, fundamental and human flows start pushing in the opposite direction from insurance. And then you have
bonds were also falling hard.
Inflation was elevated, bonds were falling hard, geopolitical, strain was elevated. And you have a similar setup here. Now you have CTAs are all long. Bonds
no one's hedging.
Hedging. You're looking for that event that who knows what it could be. I mean, Russia is supposed to be giving, Russia's having this meeting, I guess, at the UN on the 22nd, kind of ahead of the to talk about this Nord Stream pipeline. I mean, the odds of them doing something, after that, I suspect are fairly elevated. No one seems to be hedging for that. Is that the type of thing that could create it? Possibly, I don't know, but it does it makes me, concerned about adding and being too risk on here.
Yeah, no, I'm definitely, it's
I'd
one
rather
thing
just wait
to
it out.
chase, it's one thing to swing these, lovely momentum rallies. But to, the risk isn't, it's unattractive risk reward, big picture to really just look away. And I really think we are paid to wait. So that's been kind of a mantra for this year. Things over paper is still working. There's still some really good companies, cash flow positive. Energy is definitely, softened of late, but it's still underinvested space with lots of potential, and oil need is not going away. So there are tons of pockets. And that's what we do, right? So I guess I just looked at the time and went, oh my God, we've been talking for quite much more than the power hour. So I want to kind of wrap this up and say thank you, first of all, for coming to our power hour macro to micro talk. This is Craig Shapiro of Macro Advisor Craig fame for those clients who are in Slack or Bloomberg chat. For our Edge clients, those who manage money, especially, you can see this is pro to pro. You're getting a lot of real-time in coverage of what's happening in the macro markets and why, and then how to position for it. I'm Samantha LaDuc, founder of LaDucTrading.com, and I'm helping kind of operationalize as well these market moving directional changes and inflection points using macro as a backdrop, intermarket analysis, lots of technical and real time. So trading room, a lot of client engagement. We have a full desk of traders. So we really cover every, futures, oil, advanced options. So literally I have 9 contributors in addition to myself. And that's Fishing Club. For those who are interested, check it out. And definitely this Macro Advisor Edge product, which is for a very, very much pro to pro with Craig. Not just this every once in a while, webinar that we do here, but every day. He's customized presence is unparalleled as far as access to Craig to clients of Edge. So right now, I just want to kind of say sorry we went late. I've got to feed my cat. So thank you, Craig, so much. You do an outstanding job of explaining the why without any hyperbole. Right? There's just, it's cautious, balanced analysis. I love it. I've loved it for years. And I think we're much better investors and traders for it. So thank you again.
Absolutely.
Thank you again. Great. All right. And we'll do it again in a few weeks. But for now, I wish you a safe rest of the week and a long weekend. Market is closed on Monday.
Yep.
A little reminder. All right.
Okay.
Cheers, everyone.
Thanks.
Bye.